Hello, everybody. Professor Barth here, Associate Professor of History at Arizona State University. Welcome to the Dollar Report, April 2023. We have the new inflation numbers in today. CPI year over year in the month of March at its lowest level in almost 2 years, since May of 2021. Some good numbers, especially when it comes to like food prices, seem to be moderate. Inflation seems to be moderating a little bit, although it's still way too high. Nonetheless, core inflation doesn't look so good. So we'll take a look at those numbers. But before we dive into those numbers, and we'll also look at the FOMC Minutes, which were released just an hour ago or so, I want to talk about de-dollarization, because this is a topic we can't take our eyes off this ball. This is, we look at these monthly CPI numbers, we look at the FOMC meetings, the next FOMC meeting, Federal Open Market Committee, the Federal Reserve meets on May 2nd and 3rd. We'll do a video for that. So while we're focused on the short term, we also got to keep our eyes on the long term. What's going on with the dollar in the long term? And the fact of the matter is, a lot of worrying signs for the future of the dollar internationally. Many countries around the world have an interest in moving away from the dollar as the predominant world reserve currency, and this move has accelerated really in the last couple of years as the dollar has become more and more weaponized internationally in the form of economic sanctions. And a whole lot of countries are tired of the United States leveraging the dollar as a way to achieve foreign policy objectives. And nowhere is that more clear than in our relationship with China and the yuan, and especially with the war between Russia and Ukraine, and how the U.S. hard position in favor of Ukraine in that war has driven Russia into the arms of China and has decidedly increased the possibility of the dollar losing its international status, or at least its international predominance, in a major way, more so than we've seen in our lifetimes. Here's President Xi and President Putin meeting at a recent meeting. Russia, since 2022, has shifted to trading in the renminbi, or colloquially known as the Chinese yuan. And this is an effort, obviously, to reduce Russia's exposure to the US dollar, but also to the euro. And now the yuan is the most traded foreign currency in Moscow and in all of Russia. The biggest banks in Russia provide services and deposits in yuan. And if you think back to February of 2022, right at the start of that invasion of Ukraine, the West, led by the United States, but also in conjunction with the EU, delivered major sanctions against Russia and the Russian central bank in particular. Obviously, we banned Russian imports and business with Russia. But we also blocked Russia's access to foreign currency reserves in the West. Now, the Russian central bank has at the time of the sanctions, had almost $700 billion worth of foreign exchange reserves, and a good bulk of that was held in New York, in London, in Frankfurt, the seat of the ECB. And they weren't all dollars. Some of those were euros. I think a third of the Russian central bank's reserves were in euros. About 16% were in dollars. 7% were in British pounds. 13% were in yuan, and 22% were in gold. Well, the assets that belong to that Russian central bank in New York, London, Frankfurt were frozen. Assets that belong to the Russian central bank, and Russia was completely shut out of the U.S. financial system, and by extension, the global financial system. Well, in comes China. And China, of course, and Russia have been brought closer as a result of this. At a recent meeting in March with President Xi, Putin said, quote, Russia supports using the yuan in settling trades with Asian, African, and Latin American countries. The yuan in settling trades with Asian, African, and Latin American countries. The Chinese and Russians have built a pipeline between Siberia and China to trade to deliver natural gas, and so Russia has looked to China to replace Europe as its number one gas customer. That line is called Power of Siberia. There's 2 pipelines. The second one is in completion right now. And then China's also making moves. So China is taking advantage of all this. China is also making moves in South America, including in South America's largest country and most economically powerful country, Brazil. Here you see President Lula da Silva, who last month reached an agreement with China so that all trade between China and Brazil, and there's a lot of it, all trade between China and Brazil would be conducted exclusively in the yuan or in the real, which is Brazil's currency. Brazil is China's 10th largest trading partner, and again is the largest economy in South America. The Brazilians export iron ore and soybeans to China, and now the yuan has become the second largest foreign currency in reserve in Brazil, surpassing the euro. Dollar's still number 1 in Brazil in foreign exchange reserves, but the yuan is now number 2. Look for that to increase. Another reason why Bolsonaro's loss in Brazil was a tragedy for not only Brazilian interests but also American interests, in that De Silva is clearly in China's corner and in his camp, and President Xi has subsequently moved in to economically, some would say, capture South America's largest economy. And then there's Saudi Arabia, and this one is even more frightening. China, of course, was in the news brokering a historic deal between Saudi Arabia and Iran to restore diplomatic relations. Here's MBS, chief ruler in Saudi Arabia. Now, since 1974, the Saudis have traded oil exclusively in dollars, but that's starting to get a little shaky. Look at this headline from the Wall Street Journal in the last couple weeks. Saudi Arabia considers accepting yuan instead of dollars for Chinese oil sales. That's a huge deal. China buys roughly 25% of all oil exported from Saudi Arabia, and so apparently the Saudis are in these active talks with the Chinese to price at least some of its oil sales in yuan, completely breaking up the deal constructed by Henry Kissinger, who was Secretary of State under Richard Nixon. Kissinger went to Saudi Arabia in 1973, made a deal where the Saudis agreed to price all of their oil in U.S. dollars only, and then to reinvest surplus oil proceeds in U.S. treasuries, in U.S. debt securities. And in exchange, the United States agreed to sell the Saudis high-grade military weaponry to protect Saudi Arabia's oil fields militarily, if necessary, and to keep Israel at bay in its relations with Saudi Arabia. This was called the petrodollar, and it's really the petrodollar that allowed the U.S. dollar to remain the world's reserve currency even when Nixon took the dollar off the gold standard on August 15th, 1971. The world's most important commodity, oil, was linked to the dollar, was priced in dollars. Well, now that's shaky, and I think here you can point the finger at President Biden. MBS does not respect this man. Okay, he's obviously weak internationally. He hasn't earned the respect of foreign leaders. The Saudis were upset with the abrupt withdrawal from Afghanistan, the negotiations between the U.S. and Iran over its nuclear program, a whole bunch of things. But the Saudis can sense a change in the wind and are gravitating more and more toward China. And not just Saudi Arabia, not just Russia, not just Brazil, but now we learned France. In a much publicized deal at the end of March, a French energy company reached a deal with a Chinese state-owned energy company to purchase 65,000 tons of liquefied natural gas in yuan. Now, the Chinese purchased that gas from the United Arab Emirates, and in this deal, selling it to a French energy company in yuan. The first ever yuan-denominated trade, France buying 65,000 tons. There you see the zero hedge headline. Really critical, because now we have a European ally who's beginning to break away from the dollar. Remember, it was in the 1960s that Charles de Gaulle declared war on what he called the, quote, exorbitant privilege of the U.S. dollar, and it was de Gaulle's withdrawals of gold from the United States that eventually led Nixon to sever the dollar from the gold standard. But here you see this meeting between Macron and Xi. It's just schmoozing up the Xi. And then, of course, the Chinese are built this Belt and Road Initiative, also expanding economic, political, geopolitical, neo-colonial influence across the world. So, meanwhile, again, this president has utterly failed with regard to the U.S. interests abroad. There's no question about it. U.S. interests abroad have egregiously suffered under this administration, who, let's face it, is simply not respected by the people who matter overseas. And so, are we witnessing here not only de-dollarization, but are we witnessing the eclipsing of the dollar by the yuan? Well, not so fast. Not so fast. Okay, the dollar is, yes, a lot of countries, like the aforementioned, are eager to escape from what you might call dollar imperialism, dollar hegemony. They're sick of the sanctions. They're sick of the U.S. wielding the dollar as a weapon, as the U.S. has done for a very long time. I just saw in the news a couple weeks ago, the United States is talking about economic sanctions on Uganda because Uganda passed an anti-LGBT law that Washington doesn't like. And so, like the colonial powers of old, Washington is coming in and is threatening to slap sanctions on Uganda. Well, gee, if you're the Ugandan government, would you be interested in maybe moving out of the dollar system too? I think so. There are a lot of countries who are interested in this. But for the time being, the dollar, we still have king dollar. The dollar is still supreme. Look at these numbers here. These are global foreign exchange reserves worldwide in the fourth quarter of last year. So these are the most recent numbers. U.S. dollars are almost 60% of foreign exchange reserves, almost 2/3. That's a strong position. Now, it's been higher in the past. It's been like 70%. It's been around 60% in the past too. So that's remained fairly steady. Meanwhile, the renminbi is, I believe, fifth. Of course, you have the euros at 20%. The British pound, just under 5%. The Japanese yen, 5.5%. Renminbi is under 3%. That's last quarter. Okay? So there's that. And then, if you want to be the world reserve currency, China just doesn't have the proper economic fiscal policies that make the yuan attractive as a reserve currency. China has extremely strict capital controls. Its economy let's remember, it is a communist country. Now, it's introduced a lot of elements of, what you could call fascistic elements of sort of a nationalistic state-run capitalism of sorts, but it's still communist. It's still state-run. It's not an open, you don't have open financial markets in China like you do in most other countries around the world. So to have a world reserve to have a viable world reserve currency, you've got to have open markets. You have to have relatively free capital flows. Your macroeconomic policies have to be stable and relatively open. You have to have a large domestic economy. Now, China does have that, but it still doesn't compare to the US dollar. If you look at GDP, world GDP, US comprises about 24% of global GDP. That's still a pretty high number. Think about that. 1/4 of the world's gross domestic product, United States. So we've got a huge economy here in the U.S. I mean, if we could get our act together, the U.S. could still thrive in this century. The problem is we have weak leaders who aren't interested in the U.S. thriving. But about 1/4 of global GDP is United States. China's number 2 at 15%. So China, that's a large economy, right? A large economy, but it's a fairly closed economy. It's still, even notwithstanding some of the deals we pointed out at the beginning of this video, it's still not even close to as frequently used as a dollar. I mean, if you look at global payments, just globally, the dollar is like 40% of global payments. Again, the yuan is well under 3%. So it's not even a contest. Also, interestingly, China's a bit of a paper tiger here because if you look at GDP, China's number 2. If you look at GDP per capita, it's actually astounding. You realize actually China is not as strong, perhaps, as some people fear. If you look at GDP per capita, these are the most recent numbers from the IMF. The United States is number 7 in GDP per capita. Number 1 is Luxembourg. United States is number 7. China's number 64. Number 64 GDP per capita. And let me read a few of the countries here who are ahead of China in GDP per capita. Costa Rica, Panama, Chile, Romania, Bulgaria, Portugal, and there's a few others on that level ahead of China. GDP per capita. Costa Rica, okay, Bulgaria, Portugal, okay, all have a higher GDP per capita than China. Okay, so yes, a large economy, no doubt about it, an ambitious nationalistic government. Yes, of course, with a growing military, but not an open economy, and one that I think financial traders are going to be extremely hesitant in trusting. There's very little trust involved when it comes to this currency. One alternative that central banks are turning to when it comes to reserves is gold. Gold. Look at this headline from Reuters in February. Central banks bought the most gold on record last year. Gold is above $2,000 now. I think it's about $2,100 an ounce today. But look at this chart here. This is central bank buying of gold since 1950. There's 2022. Look at that. Substantially higher than at any point in the last 70 years. So we had more gold buying from central banks than at any time in at least 70 years. And so I think you're going to see as the dollar declines in importance internationally, I think you're going to see gold actually make a big comeback as a reserve that banks are going to want on reserve. Not that people are going to start using gold coins in ordinary exchange or anything, but that banks, and especially central banks, are going to want to have gold on reserve as the dollar becomes less and less trusted. I said to be a world reserve currency, you have to have stable macroeconomic policies, and that's not the case anymore. Not like it used to be here in the United States. So look for gold actually to make a comeback internationally. And if you're a foreign central bank, why wouldn't you be buying gold as opposed to some of these other currencies? Because look, as the dollar declines in importance, I mean, let's look at the other fiat currencies around the world. Are they any better? They've got a lot of inflation. How's the Japanese yen doing right now? How's the British pound doing? How's the euro right now? How's the yuan? Not that great. Okay, so look for that. But I tell you, as the the dollar will never be eliminated probably as a reserve currency. I mean, unless barring something drastic things can happen. But even if it were to fall as a reserve currency, down from 60% to 30%, that would just have an enormous change on us here at home. If you're watching this, I know I have some people abroad who watch these videos, but if you're an American, on us here at home. Because what it means is that globally, the demand for dollars is a lot less. A lot of people don't realize this, but 40%, roughly 40% of Federal Reserve banknotes are held overseas. 40% of dollars held abroad, okay? Not here in the United States. And so as if the global demand for dollars declines, that's going to make government borrowing become a lot more expensive. It will prohibit the federal government from spending into oblivion, which probably wouldn't be a bad thing, okay? But that you can kiss that goodbye if you're a big government spender. That's been enabled by the dollar as a world reserve currency. And then also inflation. The dollar's international status, because there's such a great global demand for dollars, it's tamed inflation when the Fed ramps up QE. And so we haven't really seen inflation on the level that we would see it if something like that were to happen. So anyway, keep your eye on that. That's a story that we'll certainly keep our eye on in this year and in upcoming years. Now, switching gears to a short term. The March numbers came out today. Some positive news, okay? Inflation is at its lowest level since May of 2021. If you look at CPI year over year, core is just, it's being stubborn. Remember, core inflation is when you take away food and energy. We have some bright spots with food prices. We'll see here, but let's just take a look at the graphs. Here's year over year CPI. You see a decline. Now 5%. It's still 5%, but this is since November of 2020. And there's no doubt there's a downward trajectory. As I've said before, one of the things, before I say it, why is there a downward trajectory? Well, I mean, Powell has hiked up interest rates pretty rapidly, okay? The upper limit's now 5% of the upper limit of the federal funds rate. It was 0.25% just, a year ago? Or like 13 months ago. So yeah, you get a rapid increase in interest rates. You will see a decline in inflation, what the Fed is now calling disinflation. I never heard of that term until the last couple months, and you started to see the Fed using it. Perhaps it was out there somewhere before then. But what I really like to do is, it's useful to look at month over month CPI in here. The month over month difference in the CPI is down. It was 0.1%. Now, last summer in July, it was 0%. And then we had another 1% back in December of 22. So 0.1% month over month is low. It seems to be a good sign. But, here's the line graph version. Zoom out a little bit. There we go. January 2021 to March 2023. This is month over month CPI. You can see it's a bit volatile. This could very easily pop back up to 0.5% next month or the month after. Or it could remain low, which would be nice to have a taming period of inflation. Core CPI is a different story. Okay, core CPI, again, taking away the more volatile sectors of food and energy. What do you get? Core CPI year over year actually went up year over year from the previous month. And here, the prices are definitely being a lot more stubborn. And it's really this number, what we're seeing in core CPI that is causing the Fed to continue to increase the federal funds rate. If you zoom in, this is since November 2020, the last presidential election. And if you zoom in since the end of 2021, I mean, core CPI actually has been pretty steadily high. Not much of a drop there. That's significant, okay? So what does this tell us? This tells us that inflation is still a problem. It's not... it indicates that it's not going down in a meaningful way, at least as of yet. Until we start to see core drop. Now, if we start to see core drop in a meaningful way over several consecutive months, then I think we can start to assume that inflation has been tamed. Now, at what cost? And maybe a recession. We'll look at that in a second. But here's core CPI month over month. So same idea. Zoom in on the month over month change in core. Yeah. This is not a huge improvement, is it? In fact, it's really no improvement. In fact, 0.4% increase in core CPI in the month of March is higher than what we saw in March of last year. It's higher than July of 22, and it's higher than October of 22, and it's higher than in November of 2022, all of which were 0.3%. Now it's 0.4% last month. That doesn't look to be much of an improvement. There's the line graph version. I don't know what do you prefer, bar graphs or line graphs? Yeah, visually, they seem to tell you they work differently a bit. But yeah, not much improvement in core CPI month over month. Let's be frank. And here's zoomed out since Biden's inauguration in January 2021. Yeah. Look how high core CPI month over month was in spring of 2021. This is back when they said, "Oh, inflation's transitory. It's transitory." Wasn't transitory. But still a problem. So that's where we are. The gray line there is CPI overall. The yellow line is core. Core remains an issue, a serious issue. Now, some again positives from this report: food prices, grocery prices went down in the month of March, 0.2%. Won't read through all these. Eggs went down 11% in the month of March, although still up 36% for the year. Really, the only good that went up a lot in the month of March, or at least somewhat, was cereals and bakery products. Everything else went down quite a bit. If you look at compare month over month, of course, these are grocery prices went down. If you go out to eat, my wife and I try to avoid going out to eat when we can. We got too many mouths to feed. It gets expensive. We were going to go to Five Guys on Monday, and just it was like we did the order on the phone. We were going to go pick it up. It was like $80. $80. And we got 4 kids, but I mean they're young kids, They're not, they didn't each get their own burger. $80, like what? For Five Guys? So, that went up. But food total up 0.1% in the month of March. You compare that to the rest of these months, that's a good number. Okay? That's a good number. If we can see that repeated in, April, May, June, that's some reason for optimism. Look at last year at this time. It was consistently up 1% month over month. So that's an improvement. Okay? Energy prices went down. Again, volatile sector. Gas went up a bit. Not a lot. Yeah, up 1%. Electricity, natural gas went down. So energy went down a bit, and then we got some other prices here. Here again, this is where core factors in. Apparel, furniture and bedding. Used cars and trucks went up 1% for the month of March. Motor vehicle insurance went up 1.3% for the month of March. Airline fares went up 2% for the month of March. Shelter went up 0.7% for the month of March. Now more than 8% year over year. There's a federal funds rate. Since early last year, very rapid increase. Of course, at the FOMC meeting in March, they raised it. The FOMC raised the upper limit or the target range by a quarter, by 25 basis points. The upper limit is now 5%. If you zoom out a little bit, look at that. It's drastic. Okay, so it's had its effect. Question is it enough? And it doesn't appear to be. Doesn't appear to be enough if core tells us anything. But rapid increase. Now, last little bit, just like an hour and a half ago, the FOMC released their minutes from the March meeting. It always takes a couple weeks for the minutes to come out. And the minutes tell us a lot, relatively speaking. It's not an MP3 recording of the committee proceedings. Nonetheless, it tells us something. In the minutes, the FOMC called inflation, quote, unacceptably high. Recent inflation data indicated slower than expected progress on disinflation. And there's that word, disinflation. Slower than expected progress. I think that's accurate. If you've been watching my channel, it wasn't slower than expected. We've been beating a drum on this. Just bad monetary policy. The Fed has really has not been smart over the last really 3 years. And then participants agreed that the U.S. banking system remains sound and resilient. They got to say that. They have to say that. Maybe they're right, but there's a lot of assets, paper assets that could, if they fall in value, could really expose in very serious ways some of the biggest banks in the country. And then they gave a forecast. They are expecting that the federal funds rate will peak in May. So the next FOMC meeting is May 2nd and 3rd. Okay, so what? Like 2.5 weeks. 3 weeks or something. So what does this tell us? They'll raise rates a quarter. They're not going to go 50 basis points. I think they'll do a quarter. Actually, before the minutes came out today, my guess was they weren't going to raise it at all. But now that these minutes come, and this is, it appears it's going to be a 25 basis point hike, barring something unusual happening between now and then. And then importantly, and this is what the markets are really responding to, actually after the minutes came out, the Dow fell 300 points. A mild recession, they're forecasting, quote, a mild recession starting later this year. So that's a big deal. That's in the Fed minutes. A mild recession starting later this year, with the recovery over the subsequent 2 years, presumably into 2025. What's happening in the middle of that? A presidential election maybe. So there's a lot of consequences here. But they're forecasting a mild recession. We'll see how mild said recession will be. But they're predicting fairly low growth in GDP for 2023 because of this tightening process needed to tame inflation. And then, optimistically, they're forecasting, and they may end up being correct, but at what cost? That the 2% inflation target will be reached in 2024 and 2025. We'll see. Again, at what cost? At the cost of a recession? At the cost of a major economic downturn? And if there were a major economic downturn, would the Fed have the discipline to not slash rates down to zero and do a new round of QE? Because don't you think the Fed would do that if things really started to to spiral economically, wouldn't the Fed step in and do QE? I mean, the precedent has now been set, right? Ever since 2008. That's what the Fed does. Well, even before that, that's Fed policy. So I'm skeptical of a lot of things in these minutes, but nonetheless, we report on them. With inflation, that is from the minutes, quote, with inflation remaining unacceptably high, participants expected that a period of below-trend growth in real GDP would be needed to bring aggregate demand into better balance with aggregate supply and thereby reduce inflationary pressures. Recent developments in the banking sector are likely to result in tighter credit conditions for households and businesses. Some banks are likely to tighten lending standards amid rising funding costs and increased concerns about liquidity. So tighter credit. This was one of the reasons why they justified raising the rate by 25 basis points instead of 50 basis points, because they said, well, banks are tightening their credit because of the SVB collapse, SVB, and Signature Bank. And so because banks are tightening credit and lending standards, the Fed doesn't have to be as aggressive with its monetary policy. That was the rationale. And they say so just flat out. Some participants at this meeting noted that given persistently high inflation, they would have considered a 50 basis point increase to have been appropriate in the absence of the recent developments in the banking sector, Silicon Valley Bank and Signature. However, due to the potential for banking sector developments to tighten financial conditions and to weigh on economic activity and inflation, they judged it prudent to increase the target range by a smaller increment at this meeting, and that decision was unanimous. Yeah, if Silicon Valley Bank hadn't gone under just the week before that meeting, probably would have seen a 50 basis point increase. So there we have it. Dollar report. Professor Barth will have to chew on there. Hope you have a very good rest of your April, and I'll see you next time.